Welcome to FinLoop. For decades, whenever you heard the phrase, the world's factory, you knew it meant one country, China. But that's all changing. As global supply chains get completely rewired, there's a multi-trillion-dollar question on everyone's mind. Is India ready to take the crown?
But before we get too carried away, a brand new report from the geopolitical advisors at Lazard is here with a major dose of reality. They're saying the answer isn't a simple yes. The report argues we're not even looking for a single replacement for China anymore. Instead, we're moving into what they call a China plus many world, where manufacturing gets spread out across a whole bunch of countries.
So what does that actually mean for India? Where does it fit into this new global puzzle? Well, in this explainer, we're going to dive deep into Lazard's data to separate the hype from the hard numbers. We'll look at India's incredible potential, but also the very real challenges it's facing.
Okay, let's start with the bull case, the powerful, optimistic story that has investors all over the world so excited. Why does everyone seem to think India is the future of manufacturing?
Well, the story is it's incredibly compelling. It's like a perfect storm of demographics and political will. You've got this huge, young, and affordable workforce, and at the same time, a government that is actively rolling out the red carpet for Western businesses, trying to position India as the #1 alternative to China.
And right at the heart of that whole promise is this one number, 28. That is the median age in India. And listen, that's not just a statistic, it is a massive demographic dividend. We're talking about decades of available labor, which is a huge contrast to an aging China and, frankly, most other big economies.
And that youth advantage, it translates directly to the bottom line. Just look at this chart. India's labor costs for manufacturing are less than half of what they are in China, and they're still quite a bit cheaper than other popular alternatives like Vietnam. For any company looking to move some of its supply chain out of China, that cost difference is a massive, massive pull.
And it's not just about demographics. The government is pushing, and they're pushing hard. We're talking over $28 billion in incentives just to attract manufacturers. They're strengthening their ties with the West, and they're making it easier and easier for foreign money to come into the country. The political will is absolutely there.
So, a young population, low costs, and a friendly government. The case seems pretty much closed, right? Well, not so fast. This is where that Lazard report gives us a really important reality check, digging into the significant hurdles that are hiding just beneath the surface.
Okay, so if India has the people and the ambition, what's holding it back? What's the problem? Well, when you look at the data, some pretty surprising weaknesses start to show up.
You've probably heard of the government's big, high-profile Make in India campaign. I mean, it's designed to do exactly what we're talking about, to just supercharge the manufacturing sector. But are the numbers telling the same story? Now, this is fascinating. This chart completely flips the popular story on its head. Despite all the money, all the incentives, all the talk, manufacturing as a piece of India's economy has actually fallen. It went from about 17% in 2016 to less than 13% today. It's literally going in the wrong direction.
And here is one of the biggest reasons why. India's manufacturing sector isn't nearly as independent as you'd think. It is deeply reliant on its main rival. Get this, over 30% of the components and materials that Indian factories need to build things, they're imported directly from China.
And that dependency creates a whole chain of serious risks. Think about it. If you're a company building products in India to sell in the US, you could still get hit with tariffs on all those Chinese parts. You're also vulnerable to whatever Beijing decides to do. A perfect example is mobile phones. The headlines say exports are soaring, right? But India is importing so many Chinese components to make them that its trade deficit in that exact sector has actually gotten worse.
So when you put them head-to-head, the gaps become crystal clear. Lazard's analysis shows China still has a huge lead in things like labor productivity, how resilient its infrastructure is, and just the sheer depth and complexity of its local supply chains. India has the ambition for sure, but it still has a long way to go to close these really fundamental gaps.
Okay, so we've seen the promise and we've seen the hurdles. So where does that leave us? What's the final verdict for investors and companies looking at India right now?
The report's conclusion is really unambiguous on this point. India is not a simple replacement for China.
It's just not. But what it is an absolutely essential, high-potential piece of that China plus many strategy we talked about at the beginning. It's not about choosing one over the other. It's about understanding India's specific role in this new world.
So for any company actually making this bet, Lazard offers 3 really clear takeaways. First, you've got to be prepared to navigate a complex and often politicized regulatory world. Second, don't just hire cheap labor. You have to invest in training people to close that productivity gap. And third, you have to plan for real-world disruptions, everything from energy blackouts to the growing risk of extreme weather.
And that brings us to the final critical question. The potential here is undeniable. The demographic tailwinds are real, but this window of opportunity, this global rewiring of supply chains, it's not going to stay open forever. Can India overcome its structural hurdles and reform fast enough to truly seize this moment? Well, that remains the multi-trillion-dollar question. Subscribe to FinLoop for more short-form insights on finance, investing, and global markets.